So it's been about a week since the Fed cut interest rates. We'll pose a question. How would you grade the Fed's decision? For the answer, I'll turn to the markets. There's an old trading principle. The market's reaction following a significant economic event, like a Federal Reserve meeting, well, it can be quite telling. We're watching the flow of funds. We've calculated the net capital that's moved since the Federal Reserve cut interest rates this just past September. Here, the different ETFs represent different sectors within the S&P 500. Now, the ETF that has absorbed or gained the greatest amount of investment capital since that Fed meeting just about 10 days ago, XLP, Consumer Staples. The ETF that's lost the greatest amount of investment capital is XLF, Financials. Now, in a moment, we're going to tell you why this is so important and what about this is troubling. We've also calculated the flow of funds in prior cuts. We're looking back to prior interest rate cycles for the first Federal Reserve cut or the most significant one in that cycle. For in 2007, pre-financial crisis, we look to October. Now, 10 days following that first interest rate cut in October of '07, the financials, XLF, in this case, gained the greatest amount of capital. On the other side, XLE, which represents energy, that lost the greatest amount of investment capital. So notice the divergence, and we're going to point out exactly why that isn't so important. Also, we look to March 2020. This was the COVID crisis. The Federal Reserve cut interest rates. It wasn't the first cut, but it was the most dramatic in that cycle. Now, following that cut, we waited 10 days and then measured how did the market act as after the fact. Well, the number one performing ETF was XLF, again, financials. XOP was the biggest loser. That was one that lost the greatest amount of capital. Now, putting this all together, let's crunch the numbers. Energy declined. This is in 2007 and 2020, the XLE ETF, XLE for energy and XOP for oil and gas. Those were the biggest losers in 2007 and 2020. However, to 2025, just a couple days ago, the financials lost the greatest amount of investment capital. In terms of healthcare, well, it's considered for the most part to be a defensive play. Well, it surged in 2007 and 2025. However, in the 2020 crisis, it collapsed. No surprise, it's logical. The COVID crisis was very much a healthcare crisis. Then we look at home builders. Well, home builders surged in 2020 and 2025. However, in 2007, they collapsed. That's also very logical. 2007 and 8, that was a home builder housing crisis. So the healthcare and home builder movements are pretty logical and don't raise any red flags. However, again, let's go back to the biggest gainers in 2007 and 2020. Those were financials surging to the upside, in part because lower interest rates are great for banks. However, the biggest loser this time around was financials. Why did financials behave so strongly in '07 and 2020, but so poorly today? In fact, the number one performing ETF, again, 10 days after this most recent cut, were the staples, the consumer staples, a very defensive play. The net flow in terms of the amount of net capital that's moved in or out of the ETFs, in 2007, it was slightly positive, about 10 million. Now, 2020 crisis, well, that was lockdowns and a lot of capital fled out. That was a tremendous amount of money. However, we see a mild, relatively speaking, a mild withdrawal of capital, far worse than we saw in 2007, not as severe as 2020. But most recently, the Federal Reserve cut did result in capital moving out of the ETFs, out of the equity markets, and it's important to mention that. But most importantly is the divergence again we see, the reaction to the markets following the 2007, 2020, and most recent Federal Reserve interest rate cuts. In 2007 and 2020, the biggest losers were energy. They declined due to fears of recession. It makes sense. Recession slows down production and consumption. In 2025, however, the biggest loser were the financials, and that is quite concerning. If the 2007, 2020, the reduction in investments in energy was fear of recession, what does that say about the reduction in investments in the financial sector? The divergence is important for a different reason. In 2007 and 2020, the biggest winners were financials due to lower interest rates. Federal Reserve is going to lower interest rates. It'll stimulate the economy. That's good for banks. However, the biggest winner is an ultra defensive play, consumer staples, XLP. So the question again, begs to be answered. Why is there such a divergence? Why, following the Federal Reserve interest rate cut, the first one in the cycle, in the past, this seemed to benefit financials? There was a sense of optimism. However, the biggest winner, well, investors are getting even more defensive following the interest rate cut. It's almost as if the interest rate cut wasn't enough, and there's greater concerns out there. So we ask you, tell us what you think. Do you think the flow of funds is an overreaction? Is it maybe a good time to buy the XLF, the financials? Or is this divergence, is this something significant and maybe a harbinger of something more to come? We hope this has been helpful. We look forward to seeing you back soon.